Trading the fair value gap strategy. The world of trading is filled with strategies promising consistent results, yet only a handful stand the test of time. One of the most talked about methods among modern price action traders is the fair value gap strategy, often shortened to FVG trading. This approach focuses on identifying price inefficiencies left behind by aggressive buying or selling. Traders believe that markets naturally seek balance, and when price moves too quickly in one direction, it often returns to fill the gap before continuing its trend. To grasp the fair value gap strategy, you first need to understand market imbalance. Financial markets operate on supply and demand. When buyers and sellers agree on price, the market moves smoothly. However, when one side becomes overwhelmingly strong, price can move rapidly, leaving behind inefficiencies. These inefficiencies are areas where very little trading occurred because price moved too quickly. Traders call these areas imbalances or inefficiencies, and they form the foundation of the fair value gap strategy. Just a quick reminder to please hit the like button and subscribe to the channel for more content like this. Also, you can visit us on the web at investmentees.com and use the code BLOG to receive 20% off your next purchase. A fair value gap is a price area where the market moved aggressively in one direction, creating a gap between buyers and sellers. It typically appears as a three-candle pattern on a chart. When the middle candle shows a strong move, and the wicks of the candles on either side do not overlap, a gap forms. This gap represents an area where the market did not trade efficiently. Many traders believe that institutions often return to these levels to complete unfinished orders, making the gap a high-probability trading zone. Markets are constantly seeking equilibrium. When price moves too quickly, it leaves behind areas where transactions were incomplete. Institutional traders, hedge funds, and large market participants often place orders in stages rather than all at once. As a result, price frequently retraces to these imbalance zones to complete remaining orders. This behavior creates an opportunity for traders to anticipate potential reversals or continuations at these levels. Understanding this concept is key to mastering the fair value gap strategy. The fair value gap strategy works because it reflects human behavior and institutional trading patterns. When large players enter the market aggressively, they create momentum. Retail traders often chase the move late, which leads to temporary overextension. Once the initial surge slows, price pulls back to areas where large traders may still have pending orders. This retracement is where savvy traders position themselves for the next move. Spotting fair value gaps becomes easier with practice. Traders look for a strong impulse move followed by a visible gap between candles. The most reliable gaps occur during high-volume sessions such as market opens or major news releases. Timeframes matter as well. Higher timeframes often produce stronger and more reliable gaps because they reflect institutional activity. Many traders analyze daily or 4-hour charts to identify key gaps and then drop to lower timeframes for precise entries. There are two types of fair value gaps: bullish and bearish. A bullish fair value gap forms when price moves strongly upward, leaving an imbalance below current price. Traders expect price to retrace downward into the gap before continuing higher. A bearish fair value gap forms when price drops aggressively, leaving an imbalance above current price. Traders anticipate a retracement upward into the gap before the downtrend resumes. Understanding the direction of the overall trend is essential when trading these setups. Fair value gaps should never be traded in isolation. The most successful traders combine fair value gap analysis with market structure, including trends, support and resistance, and liquidity zones. When a fair value gap aligns with a key support or resistance level, the probability of a successful trade increases significantly. This confluence helps traders filter out low-quality setups. Once a fair value gap is identified, traders wait patiently for price to return to the zone. Entering too early can lead to unnecessary losses, as price may continue moving before retracing. Many traders look for confirmation within the gap, such as smaller timeframe reversals or strong rejection candles. This extra confirmation helps reduce risk and improve trade accuracy. Fair value gap trade example. Imagine a stock that has been trending upward for several days. Suddenly, a strong bullish candle appears after a positive earnings report. The price jumps rapidly, leaving a visible fair value gap below the current price. Rather than chasing the price upward, a patient trader waits for a retracement. Over the next day, the stock pulls back into the gap. As price enters the zone, the trader watches for signs of buying pressure returning. A strong bullish candle forms within the gap, signaling renewed demand. The trader enters a long position near the lower boundary of the gap. The stop loss is placed slightly below the gap to protect against unexpected reversals. Over the following days, the stock resumes its upward trend and breaks to new highs. The trader exits the position with a reward that is 3 times larger than the initial risk. This type of trade demonstrates how patience and precision can turn a simple imbalance into a profitable opportunity. Experienced traders often combine fair value gaps with other forms of analysis. Trend lines, moving averages, and liquidity zones can all enhance the effectiveness of this strategy. Using multiple forms of confirmation helps traders build confidence and avoid low-quality setups. Trading the fair value gap strategy requires patience. Waiting for price to return to the gap can take hours, days, or even weeks. However, disciplined traders understand that high-probability setups are worth the wait. Patience separates consistent traders from impulsive ones. The fair value gap strategy works well for swing traders, day traders, and position traders. It can be applied to stocks, forex, commodities, and cryptocurrencies. Its flexibility makes it suitable for traders at all experience levels, though beginners should practice in a demo environment before risking real capital. Conclusion: the fair value gap strategy offers a powerful way to trade market inefficiencies created by strong buying or selling pressure. By understanding how imbalances form and why markets return to fill them, traders can position themselves ahead of high-probability moves. When combined with market structure, risk management, and patience, this strategy can become a valuable addition to any trading toolkit. Mastering fair value gaps takes practice, but traders who commit to learning and applying the method consistently may discover a reliable path toward long-term profitability. Thank you for watching.